Welcome back to more real estate talk. I'm Jordan Conrad. I'm an associate broker and home builder with Perry Wellington Realty. Today I'm going to give you another market update for the current week and give you some insight to the real estate market. Some of the things that we're going to be talking about is why the current market isn't like it was in 2008. We talk about this a lot, but I'm going to refresh your mind with some of the ideas behind why the market is currently different and what we're hoping will be the difference between today and 2008. Next, I'm going to talk about why would you purchase a home in Pennsylvania. So I'm going to highlight some of the great aspects of our state. Next, we're going to talk about how rentals are affecting the real estate market. And finally, I'm going to talk briefly about how the Producer Price Index, which is the PPI, influenced interest rates, which is the data that we got today. So that was the big news headline that we got February 16th. So we're going to jump right in and start talking about how the current market's different than 2008. As soon as people start to see real estate prices come down, people start to ask questions like, are we going to have another situation like the 2008 housing crash? And PARealtors.org, which is part of the National Association of Realtors, which is our national organization, they have a chief economist. His name's Lawrence Yun, and he talks, about the, the economics of the market quite often. And so today, one of the biggest things that we see that's different is the mortgage lending criteria is much stricter. So there's not what they call subprime lending, which had a lot of very loose rules. The other thing that he talks about is job creation. So we have seen good jobs data, which we talked about in our last video. And as far as the home builders go, we aren't seeing overbuilding like we did in 2008. Builders are being very cautious. A lot of the builders from 2008 never recovered. And then finally, he talks about short sales. And he says short sales are in foreclosures are at all-time lows. Today, it's 1% of all transactions. Back in 2008, it was 1/3 of transactions were short sales or foreclosures. So some pretty interesting statistics there. Next, we're going to take a look at why somebody would purchase a home in Pennsylvania. So again, PARealtors.org, they have a local market assessment, and so what they say is that the East Coast attracts foreign corporations seeking access to the Eastern U.S. and Canada. One of the biggest things I think they touch on here is that the state is becoming increasingly business friendly, gradually reducing its corporate net income tax rate to 4.99% by 2031. So this would make Pennsylvania one of the lowest in the nation. So such efforts are expanding its stronghold in advanced manufacturing, energy production, distribution, logistics, robotics, and life sciences, among other industries. So lots of great job creation coming to Pennsylvania, and obviously the government's trying to help facilitate that as much as they can. So looking at more from PARealtors.org, rentals are obviously affecting the housing market. Rent rates are obviously higher now because there's more people looking to rent because they can't afford a mortgage payment. So this is keeping consumer prices elevated, and that has an impact on inflation because that's one of the things that CPI, Consumer Price Index, looks at. So part of the Federal Reserve lowering those Federal Reserve rates depends on those rent prices coming down. So right now we're still seeing rates around mid 6%. And, we're hoping that those head lower by the end of summer, hoping for around 6%, and hopefully 5.5 by the end of this year. But if we continue to see, that the economy is heating back up, we may see the Fed take a more aggressive stance on their battle with the inflation. So some things to consider there. And then the next thing that we're going to look at is the PPI data that we got today. So there's some interesting data in this article as well. So this is out of Reuters. So what this article talks about is the producer price index. So the producer price index is the price that producers of goods receive for their products. So this would be things like chemicals, metals, transportation services, real estate services, other professional services. And so they, the financial gurus try to predict what these prices are going to come in at. And, if the prices don't meet their expectations, obviously the markets react. And so they were estimated to rise 0.4%, they rose 0.7%. And so this is kind of bad news, because this is basically, those prices being higher shows that, more inflation is present. And so with any of these reports, so with the consumer price index, which looks at things that consumers buy, and the producer price index, anytime that these readings come in higher than expected, that's a bad signal to the Federal Reserve that inflation is still present, and they may need to act accordingly to lower these rates. So that's all we're going to look at today. Again, this is your market update for the week of February 15th. If you like what you're seeing, feel free to subscribe, and make sure you also like the video. Feel free to reach out if you have any real estate questions, or if you'd like to buy or sell. That's all I have. I'll see you next week.